I'm Darius McDermott from FundCalibre, and today I'm with Richard Colwell, Fund Manager of the elite-rated Threadneedle Alpha Income Fund. Richard, hi.
Hi.
How does dividend look on the UK stock market? Are they reasonably well covered, or are there areas that you think may be under threat?
Yeah, obviously we've got a situation where the headline dividend yield on the UK stock market versus the UK gilt is as extreme as it's been over the 100 years. I think we've only been here once before, and that was in the Second World War. Yes. So we've got a high yield. As you infer by the question, it's about the quality of that yield and how is it underpinned by the cash generation of companies. So it's case by case, but I think the dividend is reasonably underpinned, but occupational hazard, there's always risks to individual dividends, but we think we can build an attractive portfolio that doesn't mimic the index, that's giving you a kind of yield of 4 or more, which relative to the bank accounts, relative to bonds, relative to other equity markets, gives you hopefully an underpinning of an attractive all-in total return. And
you have a think active, act lazy type of approach. Could you tell us a bit more detail what that actually means?
Yeah, it's a phrase that I like. I'm trying to convey by that we are not stock jockeys. We are not trading in outer stocks all day, every day. We are owners of businesses, not renters of stocks. Therefore, we're doing lots of work all the time, trying to understand better a business, trying to make sense of the valuation, trying to predict what could excite the markets or make markets fearful in a few years' time, trying to think one step ahead. But in terms of actually pulling the trigger and buying or selling meaningful positions, we are more lazy, we're more sloth-like, particularly in my income strategies. So I think that's an important differential that I think quite a lot when you read in market commentary, you'd think we were sort of fireflies trading in and out all the time. Now, obviously, there are people in the market doing that, but that's not what we're doing.
Our typical stock, how long do you normally hold that for? So 3 years, 5 years?
Yeah, at the moment, over 5 years is the average, actually. Yeah, so there's in my portfolios, there's sort of a good 10 or more stocks that I've owned for the full decade. Yeah. And likewise, there's some big parts of the market that I've not owned any stocks in, again, for 10 years.
That maybe brings me on to my next question, because you've got a sort of a contrarian value style, yet some of the parts of the market which I know are very unloved, financials, oil and gas, you're actually underweight those type of stocks. Why is that?
Yeah, I mean, you're right. I want to be contrarian, want to build up new positions in unloved parts of the market. So we're always assessing the opportunities within financials and in resources. And you're right that optically, some of the valuation ratios in that part of the market look quite cheap. So that the assessment we're doing is whether actually the cash flows are not quite as resilient or the growth opportunities not quite as attractive as other parts of the market. So you don't have to own anything,
I suppose that's the value of being an active manager. You can stay away from the areas you don't want.
Exactly, they're big parts of the index. Customers can get exposure to them either directly or through a passive fund. We're trying to do something a bit different, and be less envious of what other people own and concentrate on what you own, really. Yeah. And what's your edge, and if a share price is going to be determined by the iron ore price or the oil price or the interest rates, then maybe that's not where I've got an edge, really.
Richard, thank you very much.
Thank you.
For more information on the Threadneedle Alpha Income Fund, please visit fundcalibre.com.